All right, welcome to the Real Estate Show. It is Monday, and it's a very busy day today at the office, but we have to bring the Real Estate Show to you. So today we are talking about why multifamily properties are a smart investment. Because when we look at real estate, there's hundreds of ways to slice a cake, right? You've got people doing single-family home investing. You got people doing build to rent. You have people doing industrial, retail. You have people doing office, and then there's multifamily. So why is multifamily the smartest decision you can make? And why did I choose to get into multifamily rather than any of the other asset types out there? So like for me, it all kind of started way back when I first decided to dip my toes into real estate investing. I had no idea what I was doing. I was a real estate agent at the time. And a partner and I decided to start acquiring these residential properties. So there was a duplex conversion, there was a condo, like all that type of stuff. Now, I remember at the time, we were like in the Greater Toronto GTA, the Greater Toronto area. And in a major metro center, it's very challenging to get the yield, the cash flow you need with a single unit or even two units. So what happens is a lot of people, they end up in these small residential investments and they're negatively geared, which means that they are pumping money in every single month to keep that investment afloat. That is not a good place to be because you have, on top of the mortgage payment that you have to pay, you've got repairs, you have maintenance. And most people, when they're doing a single family home, they're self-managing, they're managing the property themselves, because they don't have the cash flow, they don't have the money that they need to go out and hire a professional manager. Now, who's going to do a better job managing? You, who's probably working a full-time job and doing a whole bunch of other stuff, or a professional property manager? Well, the professional. But if the property is not giving you the cash flow you need, if you're not positively leveraged, if you're negatively geared, negatively leveraged, you don't have the money. And that's the trap I fell into when I was doing the single family home investing. We were acquiring these assets, banking on long-term appreciation because we know over time, the value of real estate goes up. Generally, it doubles every 10 years. Every decade, it generally doubles. But what happens is, like, if you're not making money on the cash flow and you're only making money on the appreciation, are you investing or are you speculating, right? By definition, that's speculation. So I think it's really important to understand what we're really doing if we're getting into these residential properties, if we're losing money every single month and banking on long-term growth, capital growth. That's speculation. And that's really, when I look back and realized what I was doing, there was no money in the cash flow. And what happens is you get into a situation like I did where there was this tree root. So you've got the drain out to the sewer, and it was a clay pipe. It was an old property, I think built in the 50s or 60s. Anyways, this tree root had busted, boom, right through that drain out to the sewer. And that caused sewage backup into the basement. Now, number one, unpleasant smell, unpleasant situation with the tenant. Number two, it was costly to repair. So that repair cost like $8,000 to fix. That tree root went right through the drain. Now, with a residential property that's maybe cash flowing $100 or $200 in positive cash flow a month, you know how many years it would take to actually recoup that $8,000 that it cost, right? How are you going to pay for it? Well, one option is you actually pay cash of your own pocket and inject it into the property. Number two, you can refinance the property, but now you're increasing the debt on the property, and that's going to further put you in that negatively geared position because now your debt service costs go up. Or like that's basically all you can do, right? Because the tenant's certainly not going to pay for it. But this is the situation a lot of people get themselves into with single family homes and small plexes because the cash flow isn't there, right? It's just not there. So what's the solution? Well, that's when I discovered apartment buildings, and it made a whole lot more sense to me because I knew the residential real estate side. I knew about smaller single family home properties, and with apartment buildings, it made a whole lot of sense. Okay, well, I just do the same thing, but I do it another 50 times, or I do it another 30 times, or another 150 times on the same property. That made a ton of sense. So that was my introduction to apartment buildings. And so I started learning and wanting to learn more about apartment buildings. But then, I bought this one course. It was a binder like this, and they mailed me this binder, and I paid a couple $1,000, I think $1,500, $2,000 for the binder, and that was the course. I was like, are you freaking kidding me? There wasn't a lot of resources out there for me, so I had to learn and learn and learn from many different sources. I got in touch with people doing it, and it was very, very frustrating, but I eventually figured it out. But that was my journey, going from starting out in single family homes and being where most people are in terms of investing. They just want to buy a couple properties. That's how they start off. But what I realized for myself is I actually built myself a weight. It was weighing me down. It was stopping me from getting where I wanted to go once I figured that out. Because now I had these residential properties, and anyways, it turned into a big mess. But with apartment buildings, there's a lot of benefits to apartment buildings. So just to start off, because you're probably watching this right now and you're just getting into apartment building investing, you're probably like, Seth, like, what do you mean? Because some people think of an 8-unit as an apartment building, and then you drive by these high rises, and those are apartment buildings. So like, what does this world look like? Well, there's really two sides to multifamily investing. So you've got the residential side here, and you've got the commercial side. On the residential side, some people think of like a triplex, a fourplex as a multifamily property. Yes, that is the case. But when I talk about multifamily, I'm not talking about duplexes or triplexes. To me, that's single family residential still. When I say multifamily, I'm talking about an apartment building. So generally speaking, you get into, so here we have small plexes. And for me, financing is different. But for me, I really start treating an apartment building as an apartment building when you're 10 units or more, 10 plus. But, a bank, they may treat you as, commercial at 7 units. So every lender is going to be different. But for me, my personal definition, we're talking 10 units plus. Now we're into apartment buildings. Now, on the commercial side, there's really two sides. There's institutional and there's non-institutional. Now, what does institutional mean? So there are these large private equity companies that come in and snap up these properties. That's an institutional grade investor, right? They're professionals. They know what they're doing. Institutional grade asset is an apartment building that one of those institutions would be interested in buying. Now, there's going to be some ebb and flow there, but generally speaking, if you have 100 units plus, so that's 100 specific units in that building, that's going to be considered institutional. Now, non-institutional would be everything under 100 units. Now, sometimes it's 90, whatever it is, but generally speaking, to keep things simple, it's 100 units plus is institutional. Anything under 100 units is non-institutional. Now, why does this matter? Well, it matters because the types of sellers and buyers you're dealing with in all the different asset types. With institutional grade assets, right, you're going to have more professional sellers because those are going to be likely private equity companies, very experienced investors. Maybe somebody had a good exit and they snapped up a bunch of buildings. That type of person. They know what they're doing. When we get into non-institutional, you have, yes, professional investors, but you also introduce what the industry calls mom and pops. Family-owned properties where, sometimes you get some properties and there's no financials. The guy's been writing numbers on the back of a napkin for a couple of years. You go into the key drawer and it's, 100 keys on one key ring and nothing's labeled. That's sometimes what you get into with mom and pop operations. So it's important to recognize what types of properties you're going to go after if you're looking to acquire or invest in your first one, because there's pros and cons. There's challenges with every asset class, but they're just going to change depending on what asset class you're into. So again, when I'm talking about multifamily, when I say apartment buildings, I'm talking about commercial multifamily, 10 units plus, but and then there's institutional and non-institutional. So for me, non-institutional is from 10 units to 100 units, and then institutional is anything over 100 units. I hope that makes sense. Now, why is multifamily a smart investment? Well, let me just go back to my example with single family homes, because this is what I learned from my own experience. So with the single family homes, let's say I have a duplex, right? I have two tenants. I have tenant A and I have tenant B, right? So I have two tenants. And they each give me $1,000 a month in this example. And I have a mortgage, and I'm going to be a typical person, and my mortgage payment's probably $1,800. That I got insurance and all the other expenses for $200. So I'm basically treading water every single month, banking on the long-term appreciation, the value of that asset doubling over the next 10 years. Let's say one tenant moves out, right? That tenant's gone, and it takes me a month to fill that vacancy. Well, I'm short $1,000 now because I only have $1,000 covering this $2,000 expense. So now I have to go out and take my own money or find some other money and pump that into the property so I can pay my mortgage and I can pay all the additional expenses for that property. And I'm managing it myself. I can't even afford to pay for a property manager, right? This is a pretty bad situation to be in because now you're taking money from your full-time job and pumping it into this property. So you tell me any business that can afford to lose 50% of its revenue overnight, because this is essentially what's happened. The revenue of the property is $2,000 a month. That's the revenue, this business of renting property, it's generating $2,000 a month. I've just lost a 50% decrease in my revenue, right? If I have 10 units and I lose one tenant who moves out, that's only 10% of my revenue over 33% on a triplex or 50% with a duplex. It's going to make my cash flow, my revenue more stable, right? And I can plan for this type of thing. It's the cost of doing business at that level. With management, I'm generally going to spend 10 to 12% in terms of management fees if I'm renting a residential property, a duplex, single family home, something like that. With multifamily, it's more efficient because now instead of driving to 10 different houses, that property manager just goes to one site and he can manage 10 units at the same time. Way more efficient. And that's why management costs for multifamily, they can be 7%, 6%, 5%, 4%, even 3%, depending on the size of the property and how it's set up with staffing, right? Way more efficient. Economies of scale working in your favor. Repairs and maintenance, right? You've got one roof instead of 10. Way more efficient, right? Something goes wrong with the roof, you're covering 10 units instead of 10 separate roofs, fixing that, way more efficient. You've got, pest control. He goes to one site rather than 10 different houses. Way more efficient to use, right? All of this stuff helps in terms of economies of scale. Insurance cost is going to decrease because we have more units in one building rather than insuring 10 different houses, right? Tax bills, instead of dealing with 10 different tax bills, you've got one. Way more efficient. Now, this further increases the bigger you go. So with 100 units, a 100-unit building, and you have 5 tenants move out, that's only 5% of your revenue that you've lost. And you're planning this into your business plan, into your underwriting at this level, right? So you lose 5 tenants, you have your monthly turn. Every month, you're going to have 5 units turn. Perfect. You plan for this. You can afford property management because you have the cash flow, because you're more efficient. You're not underwater like you are with the residential homes over on this side, right? So again, everything just increases. Now with cash flow, that's going to help you out as well because you're more efficient. Your business is more efficient in terms of how you're operating, right? It's going to be a lot more efficient. What does that do? That's going to increase your cash flow. And first we have to solve for what's called NOI. So that's net operating income. What's your NOI? And this is how commercial multifamily is valued. So with NOI, what I do is I take my revenue. So that's going to be the rents I generate. That's going to be laundry, parking, all of that type of stuff. I add it up. That's my revenue. And I'm going to take my revenue and subtract my operating expenses. So that's going to be property management. That's going to be repairs and maintenance. Robbie, do you want to go grab that? Repairs and maintenance. Any repairs, like short-term stuff, like all of those are my OPEX. I'm going to add those up right here. And then what I do is I take my revenue and subtract my OPEX, and that's going to give me my NOI, my net operating income. Now, I don't subtract my debt service here. I don't subtract the mortgage or any debt I have because that's going to go below the line. So let's say my total revenue for the year is $1 million and my operating expenses are $750,000, right? So my NOI is going to be $250,000. That's my net operating income. And then from there, I go below this line that I drew, and now I subtract my my capital cost, my debt, right? My debt service. That's what's going to give you your true cash flow for the property. Now, if you do this for a single family home, anybody who's buying properties, single family homes in a decent market, it's going to be really, really tight, very tight. You probably can't even afford professional property management. But on the apartment building side, you're going to have a full-time leasing agent if you're in a large property, full-time maintenance guy, maintenance and repair guy. All he does is work on that building. Now, there's some advantages to this, right? If you have a full-time leasing agent, you have full-time staff, full-time property manager, if there's a problem, they're there every single day and they can manage it. They get to know the tenants way better. If you go to the residential side where you're paying 10 to 12% of your gross rents, that property manager is showing up once a month to collect the rents, right? So it's a very different relationship with the tenant. Full-time property manager, they're there every day. They get to know them, right? Their interactions aren't negative. So, hey, give me the money, and hey, something broke. They're seeing them every single day, most likely. On the residential side, property manager shows up once a month. You know, I have to give him money as a tenant. That's negative. And then anytime something breaks, I have to call the guy, and it's going to take some time to get somebody there to fix the issue. And also you're going to be way more efficient in terms of your repair requests, because, you know, if you're just walking by, oh yeah, by the way, my sink started leaking. Oh, really? Oh, let me go have so-and-so check it out. You're on the ball, rather than in the residential space, nobody's there all the time. So the tenant will, oh yeah, like 2 months ago, the sink started leaking and now there's a huge puddle before and it's gone through to the other unit. That's what happens when you only show up to the property once a month, right? Or sometimes like once every couple months, right? If you're doing direct deposits and stuff like that. So there are a lot of advantages to getting into multifamily, but cash flow is a big one. More units, more efficiency equals more cash flow. Now let's talk about stability, right? So I kind of alluded to this a little bit. Now with stability, right? If you're in that residential property and you lose half your rents, that's not very stable. Your revenue is not stable. But if you have 50 units, 100 units, 200 units, it doesn't matter. 100 units, 10 tenants move out one day. It's a bad month. You lose 10 tenants, that's 10% of your revenue. That's not 50% or 33, right? 5 units, 3 units, maybe it's 3 units on average every single month turnover. Great, 3%. That's not going to make a big dent into the cash flow of the property and the stability. So what banks are looking for when they're loaning on multifamily, they're looking for something called the debt service coverage ratio. And generally speaking, you want this to be 1.25%. So that means the property has to generate 25% more revenue than it needs to cover its debt. So it could have the mortgage payments, all of this, like all the debt, mortgages for the property. The bank is just looking for the revenue to exceed the debt service here by 25%. What that's going to do is that's going to give the bank wiggle room, a 25% cushion. So if something really, really bad happens to the property and the property loses 25% of its revenue, the bank still has its money, right? Now on the equity side, you're in trouble if you have to sell at that moment. But if you can ride it out, the bank's happy, everything's more stable for the bank. So the bank's going to look for a debt service coverage ratio of 1.25%. Now, every lender is going to be a little bit different, but generally speaking, you're looking for $1.25, right? So this is why banks love lending for multifamily, because you're probably not going to get this with a single family home. But if you look at a large apartment building, you're probably hitting that, all right? And that's why banks like it, because they know there's more units, more tenants paying, less rent defaults, all of that type of stuff. And that's why the loans that you're going to get for the asset are going to be much better. So actually, let me segue into that. So now with debts, let me just break down the difference between residential debt and commercial debt. So on residential debt, so let's say I'm buying a house, right? The bank is going to look at you as a borrower. They're going to look at your income, your monthly and annual income because they want your income to qualify for the debt. On the commercial side, the bank is going to look at the property first, right? And how much cash flow the property produces, the NOI, and then they're going to look at you as the borrower second to make sure you're not going to mess it up, right? So here they're going to look at your team. So maybe you're buying your first apartment building, but the bank's going to want to make sure you have professional property management, which you can afford because you have more cash flow. The bank's going to want to make sure that you're properly insured, you have the right team advising you, all that type of stuff. That's what they care about because they don't want you to acquire this asset and muck it up, right? Which is what happens when people get into their first residential properties. You make a lot of mistakes because you just don't know better. But if you can get involved in an apartment building, now you have enough cash flow where you can afford that help. You can afford property management that's professional, who manages 3,000 units in the area. They know what they're doing, right? You can afford to bring in potentially a partner to help you, right? You can bring in other people that you need to help make sure the deal runs. You can't do that if you have no money on the residential side and you're pumping money in every single month. So in terms of stability, CBRE did a study. So CBRE is a major commercial real estate brokerage. And they looked at the past couple of recessions, right? And economic downturns. And they looked at all the different asset types. So they looked at retail. So that's your shopping, right? Then they looked at office. Then they looked at industrial. And then they looked at multifamily, right? Those are the major four commercial asset classes. And they looked at the past couple of recessions and how those assets performed. And what CBRE found was that multifamily was the most resilient asset class to recessions. So most stable. Why is that? Because when recessions hit, now every recession is different, but they're also very much the same. Right? So every recession is taking a huge hit. Right? If we go and look in the past, retail took a huge hit, right? Industrial, the last industrial was really solid during the lockdowns and everything because Amazon basically shipped everything for us, right? Because nobody was going into stores. So industrial was resilient. But generally speaking, if you look at the past recessions and how the asset classes performed, multifamily wins. And CBRE found most resilient to recessions. Why? Because people always need a place to live. People can shut down their business. People can, stop going into the office, but people always need a roof over their heads. And that's why multifamily is so resilient. So what they found was, as rents were decreasing in all the asset classes, multifamily had the shortest rent decrease period. And then it picked up faster than all the other ones, and it surpassed its previous peak. So we all know the real estate market is cyclical, right? So I'll just draw the market like this. So here's the previous peak. With multifamily, and whenever we have an economic downturn, we have rents decrease, but multifamily surpassed, it broke through the ceiling set by the previous market faster than all the other asset classes combined. And it's for all the reasons I talked about, right? We have more tenants, we have more economies of scale. The banks actually want to lend to us, right? We have more favorable debt terms. We're more efficient. We have on-site management. For all these reasons, multifamily, that's why multifamily is the smartest asset you can buy, right? So if you're like me and you were way back and you're doing single family homes like I was back in the day, and you're frustrated because you're not making money every single month, you're banking on appreciation, which is in fact, by definition, speculation. If you're dealing with tenants yourself, right? Like I remember this one time, got a phone call from the tenant late at night. I just had a new baby too. Oh, it smells like fire in the unit. There's smoke. So we go over there. There wasn't any fire. The tenant had bought a space heater and it was brand new and the guy plugged it in and it smelled like a new space heater firing up. But I had to take my time, go over there late at night. That interrupted my schedule and everything just because the guy plugged in a new space heater. That's not what you want to be doing, right? You're not doing a professional job, right? You're distracted by so many other things. I was selling real estate full-time at the time, right? You're not the right person to manage your property. A professional property manager is. But you need to buy the right type of real estate so you can afford the right property manager who can do the job better than you. And it's not going to happen with single-family homes, right? I lived through it. Like I said, that one repair, $8,000, gone. That's years and years of positive cash flow, gone, right? It doesn't work. Multifamily, it's more scalable, it's more stable. And right now, like the economy is like choppy. Like, where do you want to put your money? In a single family home or an apartment building? This is why everybody's buying apartment buildings, because it's the most stable asset class. But a big part of getting into apartment buildings, because if you're going to buy a 50 unit, 30 unit, 20 unit, 100 unit, 150, 200 unit building, you have to learn how to raise money. Because most people in the space, unless you own a sports team, right? Most people in the space, they're not going to put all of their money in a single deal. They're going to go out and raise money from other investors, right? So if you want to learn how to raise more money from investors, whether you're just starting out, like me, I had no idea how raising money worked. If I did, I probably would have switched a whole lot sooner. But I thought I had the limiting belief that I had to save up money and then go buy another property. Save up more money, then buy another property. I didn't realize that there's investors out there who actually have money that they want to put in a deal. They just don't want to do the work, right? Because they're busy doing what they do. I had no idea that world existed. And I remember I went to something in Philadelphia, and it completely changed my life, because now I actually started understanding how money works in real estate. I was very ignorant before. So what I'm doing is coming up in 2 weeks. So July 20th to 21st, myself and Brad Blazer, he spoke at my conference. He's raised a lot of money in his career. We're hosting a 2-day capital raising intensive. So if you're interested in doing this, we've got two ticket types. We've got $897 general admission, or you can pay a couple $100 more and do VIP. We feed you. We got special VIP events, more access to me and Brad during the weekend. This is a small thing. My big conference, we get thousands and thousands of people. This workshop, like, we're a small group. Like, it's more interactive and it's all content. There's no fluff. It's straight content for 2 days. We're literally walking you through the capital attraction system. We're walking through how to run an investor call and how to close investors, all the scripting you need, how to actually market an investment. If you're running ads, not running ads, how you're going to get in front of investors, all the way through how to structure the deal, all the compliance stuff you have to know. Everything A to Z or A to Z that you need to know about capital raising, we're doing this at the 2-day workshop. So if you're interested, just go to the link right down below here, Robbie, if you can put that up. And there's a couple seats left. Grab your seat, small group. It's going to be more intimate, and it's all content for 2 days. So you're literally leaving this capital raising workshop with the exact blueprint that you have to execute on to start raising money. I wish I did something like that before I even bought my first property, because I would have done things completely differently. I was stuck in my mindset, in my knowledge, because I didn't actually have anybody in my network who was doing that. So I didn't know what I didn't know. I thought you just saved up and bought another house, saved up, bought another house. I didn't realize there were actually investors out there looking to place capital. Like those 10 years would have been completely different if I knew this stuff. So this is your chance. $897, $1,297, small group we're hosting in Toronto at Ryerson University. It's going to be a great 2 days. I'm actually really looking forward to this, because I get to geek out in terms of some of the minutia and the technicalities in terms of scripting, how we run calls. Like, right now, if you're having investor conversations with somebody, and you're getting a lot of, oh, I need to think about it, or, oh, this looks nice, talk to me next year, or, oh, I'm just not sure, or, oh, I have to talk with my wife. If you're getting those types of objections or responses from investors, you have to come, because we are dealing with that, and we're going to change completely how you run your investor conversations to make sure you're closing. So again, it's July 20th to 21st in Toronto. Really looking forward to seeing you there. So if you haven't got your ticket, make sure you do it, because it's a small group. We're not selling hundreds and hundreds of tickets of this thing. Okay. So if you're right now investing in single family homes, take a hard look about what that property is doing for you, and if you can be more efficient, and if getting into apartment buildings is more scalable for you, and if it will make your life easier. Because if you're managing 10 different houses, 10 different tax bills, 10 different tenants or more, right? 10 different service calls for everything. An apartment building, it will clean everything up. It'll make you way more efficient. Okay. So that being said, I hope to see you at the capital raising workshop, and I will see you tomorrow for the bullpen, which is our sales show. Tune in for that. All right. See you guys later.